Welcome to the April Market Strategy webcast. My name is Alastair George. In this month's edition, I will be reviewing global asset class performance for the first quarter, our current thinking on US and Eurozone monetary policy, introducing some new research on market valuations, and putting events in Eastern Europe in an investment context. In terms of global asset class performance, the major asset classes such as developed market bonds, US equities and European equities are effectively flat year to date. In our view, this is due to investors pricing in the first monetary tightening steps we have seen for some time. The best performing asset classes have been precious metals and agriculture, both benefiting from geopolitical uncertainty, but also in gold's case from starting the year in an oversold position, close to the industry's marginal cash costs of production. At the bottom of the chart we find the Nikkei, one of 2013's best performers, and copper. For copper, investors should watch events in China carefully. Copper is both an industrial metal and has also been used in financing trades to gain exposure to the rising Chinese renminbi. China has recently allowed the currency to fall against the US dollar, causing losses for exposed investors. At the same time, there is anecdotal evidence of credit being more difficult to obtain in China, which is also slowing the economy. Recent flash PMI numbers below 50 indicate a weakening growth trend. As the world's second largest economy, this is clearly something to watch closely, especially given the rapid expansion in credit to finance growth. For US monetary policy, so long as there are no material declines in GDP expectations for 2014, we believe we may have passed the point of peak monetary accommodation. The original factors in favour of QE are simply no longer present. Unemployment, as measured by official data, has fallen to the Fed's initial target levels. Risk premia within the banking system and financial markets clearly are no longer elevated as they were in the immediate aftermath of the global banking crisis. In reality, risk premia are now compressed and as such may present their own risks to financial stability. The message from the most recent FOMC statement was clear. Monetary policy accommodation will be progressively removed, first by a steady reduction of quantitative easing in 2015, and only then followed by an increase in interest rates after a considerable period of time. But the surprise for markets was Yellen's definition of a considerable period of time. When questioned, Yellen indicated she was thinking of only 6 months after the end of QE, which puts the first US interest rate increases as soon as Q1 of next year. The change to a more hawkish outlook for monetary policy has been noted by markets. 2-year US interest rates have moved 15 basis points wider since the FOMC meeting. In the Eurozone, the situation is very different, as the ECB is faced with significantly below target inflation and outright deflation in the periphery, as most recently confirmed by data from Spain. At present, there is some uncertainty over the ECB's near-term thinking. Draghi's press conference last week surprised us as he appeared to rule out any further policy action in the short term, as in his view, inflation expectations were well anchored. There has been a timid convergence in lending rates across the Eurozone and recently improved PMI data. Yet within a week, we have public comments from the hawkish head of the Bundesbank suggesting that outright QE would be possible in the Eurozone. There was also further comments from other members of the ECB Governing Council supportive of negative interest rates. This makes the direction of ECB policy difficult to determine. But ultimately, we believe if Eurozone inflation continues to fall, further policy action will be forthcoming, if only as a covert attack on the strength of the euro. For market valuations, we have been refining the view. Last year we became more concerned about relatively high valuations, especially in the small and mid-cap sectors, although since then markets have in fact moved sideways to slightly higher. Valuation is not a short-term market timing signal, but even over a 2-year time horizon can be a helpful predictor of stock market returns. Therefore, to refine the view, we've created a bottom-up model to forecast the market by aggregating statistical return forecasts for individual stocks. If you need to have more detail on how it works, please get in touch using the details on the slide at the end of the presentation. Using this statistical approach, we can achieve up to 70% explanatory power in terms of the variation of stock returns from the mean. Looking at the US, the model shows the gross overvaluation in the dot-com era indicates lower than average expected returns just before the financial crisis, followed by its higher ever return forecast in 2009. All this corresponds to the outturn over that period. Notably, the model is currently forecasting a level of returns for the US in line with historical averages, which is rather more bullish than the top-down parameters imply. This is the result of a relatively robust corporate performance since the start of the decade. In the UK, the situation is not as encouraging. The model fits well, but the current forecast is for negative returns on a 2-year view, which is one of the lowest readings. But we can also use the model to help us understand the distribution of value, in this case by splitting out the results by company size. There is a big contrast between the dot-com era and today. During the dot-com era, the overvaluation was focused in large-cap names. Today, these are comparatively the most attractively valued. We think investors should take care with small and medium-cap companies, and that also includes some of the more speculative new issues which have come to market in recent months. In Europe, excluding the UK, we are a little surprised at how sharply the forecast return has been dropping. This is due to profits forecasts that are not living up to the hope embedded in rising equity prices. Unless we have a strong recovery in core profits in 2014, investors may start to question this rally. In the last few months, investors have also had to contend with geopolitical risk. Ukraine is a complex overlay of defence interests, energy politics, all combined with a struggling Ukrainian economy. Clearly, Ukraine itself is of virtually no significance economically, with a share of GDP of less than 1% of that of Europe. But as with Greece, the leverage, in terms of precedent and wider implications, make the situation much more important than the pure economics. We believe the key issues are, for the West, a seizure of sovereign territory by force and without due process. For Russia, the encroachment of EU and NATO-friendly nations on Russia's border. For Europe, the continuity of supply of Russian energy. The stark reality is that in the short run, Europe will be severely impacted by the loss of Russian gas, but Russia will be severely impacted by the loss of the associated revenue. It really is in no one's interest to escalate now. We think Russia will not attempt to escalate the situation further in the near term, reports of 50,000 troops near the Ukrainian border notwithstanding. If eastern Ukraine is not invaded, from an investment perspective the changes to our already cautious portfolio positioning are modest. Let's be clear, we still see overvaluation and the renormalisation of monetary policy as the key risks to investment portfolios. But the increased risk premium for Russian assets is clearly justified, at least until the uncertainty over Russia's ultimate ambition in the region has been eliminated. We remain cautious about Russian risk, especially where it involves long-dated, fixed asset-intensive projects, typical of the oil and gas industry, which ultimately, in the worst case, could be expropriated. For defence, Europe has long been criticised for failing to spend as much as half as the Russia or US level as a percentage of GDP. At the margin, we see the trigger for reprioritising defence spending, even if it is a matter of not cutting rather than increasing expenditure. Therefore, we would suggest investors consider refocusing their attention on this underperforming sector. There may also be specialist opportunities arising from both Europe's and Russia's need to diversify energy supply relationships. In summary, we believe markets are now moving sideways as US QE draws to a close and investors pay more attention to extended valuations. We still think markets are relatively expensive, especially in the small and mid-cap sectors, and see the recent flourish of IPO activity as, in general, a better opportunity for the seller rather than the public equity investor. There is good reason to think that an uneasy truce may develop around the Ukrainian situation, and therefore little change to our cautious portfolio strategy is required, as there are currently few systemic implications. That concludes the presentation. For more information, please contact Julian Roberts using the contact details shown on the slide. Thank you for listening.